The agenda, I think, is quite clear. I think we need to be looking at what's happened in the union budget and how that's going to shape the outlook. Now, I think what's important is a bit of context around the budget itself. And one of the things which I've noticed increasingly on the budget is, of course, there's a lot of anticipation, but um, very often and more often than not, most of the budget discussions tend to result in not too much happening during the budget. I think part of the reason for this is that a lot of the decision making is shifting outside the budget. So, for example, last year, I think the most important piece of reform for the markets, at least, was the cut in the indirect tax cuts, and not just in terms of indirect tax cuts, but GST, whatever else there was also a reduction of the number of slabs also. So together, that was maybe the most important market moving event which happened by the policy on the policy side. But that didn't happen in the budget. That happened outside the budget. That happened in the middle of the year. So like that, I think the increasingly a lot of the policy decisions are being taken outside the budget. So going into the budget, just setting a bit of the context of where we were going into the budget. We were in a situation where the nominal GDP at least was quite weak. Where and This is important because the taxes really are decided based on the nominal GDP. So the revenues, the tax revenues, and even the top line for many companies is dictated by what the nominal GDP growth rate is. This was quite weak going in. Plus, we had direct tax cuts in the previous year, and we've had indirect tax cuts also in the previous year. So going into the budget, there was quite a bit of constraints for the finance minister. And what she did was a very good balancing act in this context. So I think the expectation that there would be more tax cuts, whether it's on the long-term capital side or whether it's on the short-term or even on the STT, which I'll get to, all of those I think were a bit misled or a bit hard to hope for. And despite whatever the constraints, I think the headline is that we were able to maintain the fiscal deficit reduction path. Now, why is this important? I think in this budget, it's like what they say about doctors. Doctors are that they have the oath which says that first do no harm to the patient, and by maintaining this fiscal path, I think what the finance minister has been able to do here is the government has been able to achieve is that they have done no harm to the economy. It's a budget which maintains the path which was spoken about earlier, and was able to show that the borrowings were slightly higher than what was expected, but only versus expectations rather than versus absolutes. I think my absolute was still along the path which we have talked about. So this is something which the gross borrowings I think were a bit maybe marginally higher than what many was expecting, and that led to the 10-year being a bit firm. What we are looking for, therefore, is that this is a budget to be pragmatic and continuing along this path, which is what has been telegraphed in the earlier budgets also. So just move into some more highlights of the budget. I think the assumptions underlying it is pretty reasonable. You've got the growth rate of about 7%. You're assuming about maybe 3-4%, maybe 3-4% in terms of growth, inflation as well. And so totally about 10%, 10 to 11% in terms of nominal GDP. So we're expecting the we're expecting the economic growth to bounce back to the 10 to 11% trajectory. I think there's reasons to believe that that is going to happen because if we look at the recent indicators, economic indicators, we are seeing that the credit growth on the bottom right is showing signs of picking up, and that is normally a good indicator for nominal GDP also picking up. So together, we are looking at economic growth, GDP growth starting to pick up. We're seeing real indications also like electricity or cement or traffic. All of these are starting to pick up. IIP also was pretty strong in the last month. All of these are signs that GDP growth is picking up at the nominal side and at the real side, which means that we are in an environment where you are looking at confluence of different factors coming in together. And because of the cut in the GST, we are seeing auto sales also pick up pretty sharply. And this is sustaining beyond October as well. November, December also, and January are pretty strong months for the auto retail sales. So together, and along with the fact that rural indicators are also holding up pretty sharply, these are all pointing to an economic growth sustaining and holding up. And therefore, if you go back to looking at the nominal GDP growth, this declining trajectory towards 8.7, 8.9, so 8 point below 9%. This should pick up, and like we had last year, a second half recovery. I think we should have that kind of a recovery again playing out for the economy, and it should sustain this time through to the next year as well. So on all fronts, we are looking at some of these assumptions which is being made in the budget being pretty solid and pretty reasonable. Apart from that, I think the other parameter which we look at quite closely for the budget is the capex. I think there was a fair bit of optimism around the capex. I think some commentators have said that there is it's a strong capex, but I think for us it was pretty much in line with what was mentioned in the past. We have been on this trajectory where capex to GDP at least is remaining flat. So capex to GDP, we should expect कि अगर nominal GDP का growth over 10-11% है तो फिर capex भी उसी I mean तेजी से बढ़ेगी. I think that's the kind of growth which we should imagine going forward. And so it was in line. I think capex at least it was mostly again in line for us. The details though are important. यहाँ पे what is important is that हमने देखा है कि we are seeing that defense growth, I think 17-18% is more what we were expecting. But I think some market participants were expecting even more. So I think expectations is what is more has driven some of the many reactions to the stocks rather than absolute. But 18% growth is very healthy for defense. Road and railways on a pretty reasonably elevated base are growing at about 8 to 10% as well. So I think that is also pretty healthy. The challenge for road and rail actually is in deployment. So finding ways to deploy this 8 to 10% incrementally is more and ensuring that those projects are well executed is the bigger problem. So I think that is the other thing, second part which we're looking at. So support, so that is so on capex broadly in aggregate in line. So the other part on capex which I mentioned is that a lot more capex is now shifting towards the states, the state side. So the lot of the budget is, so after executing at the union budget side, now we have more of the budget being allocated to the states to execute. So I think in terms of urbanization, in terms of creation of more social infrastructure, which is education, healthcare, these are more in the hands of the state governments. And so the state line item, which is transferred to the states, also saw a reasonably strong growth. And I think that's an important message across this entire budget, where we are looking at more in the hands of states, because that's where there's greater control for the governments, and some of these can only be executed at the state level. So those are the main ones in terms of the message. In terms of support for MSMEs, I think they've already been done. it's building on what has already been done in the past. So this is one more initiative which is done. Infrastructure and skill development, I've already spoken a bit about these. Just moving a bit more to the granular levels, I think looking at what each sector is facing, we are seeing that the financials basically, I think these are, the financial sectors across the board. The main headline which got a lot of attention was the second one, and I think across all sectors, if we look at it, maybe this is the only one where we look at the second column, impact, which is just outright negative. There was mostly otherwise marginal positives or neutrals. I think that is the sign. That is how most of the sectors were impacted by this budget. But this exchanges and brokers were the only one which were outright negative in terms of impact. The reason for this, I think, is being well telegraphed. Actually, when we have been slightly wary on the capital market companies, because we have felt that one of the reasons that we said being that the government has been pretty vocal. The government has been pretty clear that it is concerned about a lot of the F&O activity which is happening, particularly at the retail level. It wants to increase the cost. It wants to reduce the amount of activity which is happening on the F&O side. And this is one such measure. It's a blunt measure actually, because there are better actions which might be taken. And I suspect that we may actually have more actions taking place in the rest of the year to curb F&O activity. So that has kept us cautious on the capital market side. I've been worried about the capital market side, and we therefore think that what action is being taken is slightly in line, and we were maybe even thinking that there could be some action like this during the budget. So for us at least, it was not entirely unexpected, though I think the market definitely was caught a bit unaware more broadly. On banks and NBFCs, not too much. It's marginally negative because of the higher gross borrowings, but these are marginal negatives only. I don't think there's too much which was hurted on the borrowing side. The more important one was the possible merger of something like a PFC and REC, which I basically mentioned. And the other is the setting up of this high-level committee on banking. This is interesting because it, I think, came out of the blue. We're not really aware of any such measures which are being talked about. And even today, it's a bit unclear, it's a bit uncertain about what the aims of this are going to be, even in subsequent discussions which the finance secretaries had. Everybody mentioned that the terms of reference have not yet been decided. So there's still uncertainty around what is going to happen. The expectation, at least, is that we may see some more mergers of PSU banks and or measures along those lines. If these PSU reforms, maybe shifting in the ownerships. So some of those kind of measures, I think, may be proposed or suggested by the high-level committee, but it's still very, very uncertain, and we'll see how this plays out in coming weeks. On fintech and insurance, not real. So fintech, there was a bit of worry around sometime last year about the UPI incentives and some worry that may be removed. That again, I think, is that didn't happen, so it was a positive. Insurance, well, there were no changes to the intermediate and distribution costs. There's some talk that maybe it can happen in this budget, but this is not the forum for it to do, and the government, I think, rightly stayed away from taking such a measure. Moving to more the infra and capital goods kind of space, building space. Infrastructure we've spoken about, road and rails expected to grow at 8 to 10%. Capital goods were positively benefited by the defense play for sure. But the other theme on this particular budget, was about services and more support being given to data centers itself. Actually, if we look broadly at the capex, and I'm just taking a bit of a diversion here, to speak a bit more broadly about capex in the economy and how we are looking at capex more broadly. There are really 3 or 4 places where capex on the private side is picking up. Mostly it's pretty muted, but if you look at some 3 or 4 pockets where capex is happening, one of them is data centers, where there is a major push happening over the next 3 to 5 years. In this period, we can see our data center capacity grow by 9 times and reach 9 gigawatts by 2030 or so, based on the current plans. But I think what can happen is that even with the measures announced here, you might even see that getting accelerated by even more. So these are orders of magnitude investments which are happening, and there are plays which are there in this entire space, and they are expected to benefit. The second part, I think, where we are seeing investments, and that is something which is positive, is generally the renewable space. And here we saw some more impetus being given to that. The increase in the solar energy scheme, basically the solar rooftop. So as the Indian capacities on the modules, cells, vapors, polysilicon comes online, the government is giving a push for demand as well to underwrite some of the made in India solar infrastructure, solar mass rather. So that I think is the second place where you're seeing private sector. So data centers, renewables. And the third one where we have seen where we have actually seen some increased some element of capex taking place on the private side is electronics manufacturing. And here also we saw some measures being proposed by the government on the electronic or the semiconductor mission 2.0 and the electronics component manufacturing scheme. So basically the what the government has done here is that they have supported the entire growth which is happening on the they have supported the growth which is already happening on the private side. So while the private sector is investing in these sectors, the government's actions will serve to give more confidence to the companies which are already investing here, and maybe even accelerate some of the capex which have been proposed. Beyond this, I think what we have seen is that there is oil and gas one-time grant to PSU oil marketing companies. So that is something which has happened here. At the same time, the direct benefit transfer for LPG allocations have been revised slightly. Fertilizer subsidy has also been cut by about 8% here and there. Beyond this, I think broadly IT services have also seen a bit of a flip coming through in this. So I think here, not too much more. So the budget thrust again, as I said, these 3 sectors have gotten a lot of focus, and rightly so. The sectors which didn't get any focus at all, I think, were consumption and the like. I think that was completely almost ignored in this budget, which I think is fair given the indirect tax cuts which have happened last year, and direct tax cuts as well. I think that was something which meant that there's not too much need to push any more actions here. A couple of other measures were proposed, the auto industry side, the proposal for rare earth corridors to help in higher localization of EV manufacturing, I think is a positive. The context, of course, is that China's actions have made it all more important for every country to invest in rare earth sites. So India is starting, so don't expect too much from this. Very honestly, I think there's a bit of excitement around what can happen here. But rare earths are very, very, very complicated or very environmentally unfriendly. They are difficult to extract. They take years to actually put into effect. So you can start the action. You've got to start somewhere. The government is starting, but it will take many, many years to start to have rare earths actually being produced. So I think that's the overall picture for the budget. In summary, on the budget, I think the most important part about the budget per se is that for us is that it maintains a macro stability. We are continuing to be on the path of fiscal consolidation. At the same time, the government has been very targeted about the measures which it wants to support. It wants to support manufacturing. It wants to support the services which are building in India. And this is a shift from earlier budgets, which are a lot more maybe focusing a bit more on the rural side or consumption. Here, the focus was clearly on creating more of a focus on manufacturing and services. The other thing which I noticed was that this budget also was less about making it annual schemes in a sense, like we're putting small amount of allocations here and there and spreading it all over. There was a lot more focus about making it just about 3 years, 5 years, 10 years. Those kind of vision was what was presented. And I think that is also important because if you look at most countries, they don't really pay too much attention to the budget. And the reason why that is the case is that there is, by and large, a stability which is there in the budgets. In India, the thing is that we have tended to see the budget as an annual exercise where things can be tweaked here and there. But the tweaking comes at the cost of lack of stability for investors. The less tweaking that happens every year, and the more stability that investors have, the better they can plan and they can attract more FDI. So I think a shift towards actually maybe less things happening in the budget is something which is also positive, which I will take away from this budget for the budget for FY27. Which brings me a bit to what's happening on the markets and how should we view the effects of this on the market. The key issue for the markets, in our view, has been really the earnings growth. Earnings growth has one is that the earnings growth itself had declined last year. But what was worse than that was actually we started off at a higher level. We started off by expecting about 14-15%, and it got cut pretty sharply in the middle of the year. And that was mainly the reason why we saw the markets stagnate. We have since then seen the growth engine being revived with the rationalization of indirect taxes, repo rate cuts of 125 bips, should be 125 bips, and CRR cuts as well. Lots of liquidity, lots of low inflation and good monsoons also helping. What is useful is also that the RBI has this third one, which is the easing of macroprudential norms. Basically, it's a unnecessarily complex word for what is telling the banks to go out and lend. I mean, ease of doing business for banks. That is the regulatory actions of the RBI on banks has been eased very, very considerably. And we have already seen the effect of that. I'd already pointed out how the credit growth is something which is picking up. So there are, and I'll just return to that to really highlight that there is some serious improvement in the economic trajectory which is happening. And that is setting us up very well for this year. So going into the next year, I think if you just look at what sectors worked last year and what sectors are starting off well, we think that financial services has done well last year and can continue to do well this year as well, particularly on the banking side, particularly on the lending names. So what we are looking for is that with the interest rates having been cut by 125 basis points last year, we saw that resulted in their margins being compressed as their deposits take time to reprice, but the loans get very often linked directly to the repo rates. So that compression happens that pay for the margins. Now this year, the margin will expand again, will normalize again, and you will also, with the effect of the credit growth picking up to 14% in December, I think we'll start seeing the full year effect next year. In the middle of last year, about May or June, the credit growth was down to about 8 to 9%, which is really low, and that is really symptomatic of how weak the economy had become. And that 8 to 9% GDP growth, nominal GDP growth, was really reflected in the credit growth as well. Now, with the credit growth picking up to firmly double digit, I think the nominal GDP numbers should also follow through. Typically, we have component which tends to be there, which is that nominal GDP into about 1.2 times is what the credit growth should be. So if credit growth is at about 14%, then you should expect nominal GDP to be, well, maybe 11-12%. So that really is pointing to pickup of nominal GDP, which is good for the corporate earnings as well, broader corporate earnings. We expect the beneficiaries on the corporate side as a result of the pickup in lending to be on the more on the consumer side, where we expect that apart from autos, which I've already pointed out, we expect a broadening of the consumer durable spending. So consumption is something which has been a bit slow. And consumer durables, in fact, apart from autos, really haven't fired. In fact, on the consumer discretionary side, you're seeing a slowdown. And we look at if you look at some of these stocks here, last year we had consumer durables doing pretty bad, and this year also it is continuing. But in this year, we are expecting that this should reverse. And as the year progresses, maybe as the summer season picks up, there's a half decent summer season, then some of the consumer durables selling that can start picking up, and spending along those lines can drive some of these stocks here. So that is one of the spaces which we like. And also, along with the cut in the GST has not really benefited some of the retail names, where I think some of them, at least some of the companies have called out a bit of a dampened spending. But they're pretty confident that some of this can reverse in the coming months. So every reason to believe that consumption can broad base and do well here. The other sector which has not done well at all in this environment is the real estate. Of course, it came off 2 very, very strong years, and there's some concerns around the volume growth which is there across the different cities. But we think that is something which should really reverse. The fundamentals on the ground have not been shaken too much, I think. We have, if you look at inventory numbers, it's picked up a bit from the absolute bottom, but if you look at absolute numbers of inventory, it's not really reached any worrisome levels. And if you take along with that the fact that you are seeing, you're going to see the home loan rates fall very sharply, and maybe it will go to all-time lows. This sets up real estate again for pickup. So I think that's the other sector which we can see some more action. Because if you look at the pre-sales trends for most of the developers, it's just continued without any interruption at all. So trailing 4-quarter pre-sales has been very healthy. And so despite the health of the companies being very strong, these companies have corrected out of concerns that there could be an impending slowdown, but we don't see signs of that. And as accumulation of this happens, these stocks can also pick up. The other sector which is maybe not done well, and where we have not entirely taken a excessive calls reviews on the IT sector. Of course, this is being impacted by the entire artificial intelligence related concerns. The risk here is, so when you look at the commentary of what the companies are saying on the AI side, it's that AI is now, it's moved from concept to really reality. And I think 90% of Fortune 200 companies are now involved in some kind of AI-related projects for our IT companies. So there is definitely adoption of AI in some way is happening, whether it is in terms of cost reduction, whether it's in efficiency gains, whether it's in smaller projects as well. But what is, so there'll be no direct massive impacts, and it's very unlikely that deeply embedded systems like SAP, for example, are likely to destructed overnight by some of these agents. It's far too risky. The AIs are not yet reliable enough to deploy on short notice, and debugging and a lot of the software code writing still requires humans. So in the near term, it may be that these the earnings for these companies are not massively impacted, and you may still see that companies will continue to earn good, will continue to have good earnings and grow maybe as well pretty reasonably. But market right now is in the phase where it is looking to derate some of these companies on future concerns, and I think that's the dynamic which we are really watching for. What is clear is that at least in the near term, amount of labor which was required earlier is unlikely to be required by some of these companies because there is going to be a 15% at least productivity gain for some of the software developers. So when earlier makes up about 50-50 being in terms of labor directly how many employees you have, it's likely to shift further away from that. So there is long-winded explanation for saying that yes, there's a lot of flux here, and the markets are more worried about a long-term derating than about the short-term earnings trajectory on the IT side. So we are more near to this because these stocks are throwing out a lot of cash. They're still pretty cheap, and the earnings continue to grow. So I think that's something which we are continuing to monitor. The other name which I have to mention here, of course, is the metals index, and metals has generally done pretty well last year as well, and it's had a strong start with this year. But I think the commodity part itself has done quite well, led by the China anti-involution trade, and we should continue to see some of that playing out. I think the anti-involution trade has meant that metals is doing doing pretty well, and some of the demand supply concerns for some of these metals are coming more the there is some level of demand hasn't really picked up as much for some of the base industrial metals like steel, for example, but the visibility for some of the other metals is looking a bit better. Of course, we have gold and silver, which have done exceedingly well, and maybe I touch a bit about them as well. So I think gold and silver has run up much higher than what we have seen in the past, and more recent charts are really showing that at least compared to some of the stock markets and other commodities, silver has run maybe very sharply, while even gold seems to be approaching some of the numbers or levels where it's maybe more attractive to be in the stock markets than to be in the precious metals itself. This coming back to the stock markets itself, and we have seen that the large caps have typically been more reasonably valued than the mid and small caps, and that's been our position as well. Here we are seeing that there is a bit more, and the valuations in the large caps are about maybe slightly lower than 20 times 1 year forward. So pretty okay. I mean, off the highs, not extremely concerning. But if you look at some of the mid and small caps, in fact, in the last month, the small caps have corrected pretty sharply. I mean, the last few months, rather, the small caps have corrected pretty sharply. Here we continue to see that the small caps are still reasonably elevated in their valuations, even compared to large caps. So in absolute terms, it's not yet become very good. Maybe another 5 to 10% relative underperformance versus the large cap will bring the small caps to levels which are far more attractive. So near term, I think small caps can continue to underperform the large and mid caps, but we are setting ourselves up for a pickup in small caps because just getting back to the fundamentals on what will drive small caps and why the budget again is important. The thrust on manufacturing in particular is something which benefits small caps more than large caps, and even mid caps. So, um, a budget which is friendly to manufacturing, government which is looking at growing manufacturing, and the signing of the the FTAs as well is also the free trade agreements with European Union, US, UK, and many other countries, means that all of this should start being drivers again for the small cap. So sometime in this year, we should start seeing the small caps come from and starting to pick up. And I mean this not just from stock performance, but also from the earnings, because if you look at the last 2 years, the earnings of the small cap has been weaker than definitely the large caps and the mid caps. At the same time, if I speak about the mid caps, they continue to be, just look at the absolute numbers at about 26, 27 times going forward. They're still the most expensive pack. But what I should also note is that this is also the pack which has grown their earnings best in the last 2 years. So 15% growth rate in the last 2 years on average, while the rest of the market is growing in single digits. So that's why the valuation premium continues to be maintained. And you should expect that as long as the earnings are coming through, the mid caps can continue to be a bit expensive. So that's where we are on so in this, so just summarizing this, going into next year, we are looking at an earnings pickup, and we can see we're looking at earnings picking up, and there's a lot more stability coming in the earnings projections for the next couple of for the next year as well. So if you look at generally this trajectory of these worms and how the expectations for FY27 are panning out, we have seen more stability in the last 8 months than the previous 8 months. And that means that there's a lot more confidence coming into the market for the earnings projections, which means that there's likely to be a lot more as these get played out, because next year we are looking at about 15-16% growth rate. We should see the market starting to move in line with this earnings growth rate. What has hurt the market really has been this compression in the earnings for FY27. The growth rate has been for FY26, and that is something which meant that the market has not been able to go anywhere. So this opening out gap into FY27 between these two worms means that we should have a better year ahead of us. Valuations also have become a lot more reasonable, as I said, in the large, mid, and small across board. So we are setting ourselves up for a more constructive next year, and I think the union budget has only served to help us consolidate along that path. Pause here and take some questions here if there are any. Thank you. Sorry, I can discuss a few of our focused funds also.
Yes, please.
Sure. So in this entire environment which we are in, we are continuing to focus more on some of our diversified funds, which is the India Opportunities and the multi-cap funds. As I've said that the small caps have not done maybe as well in the recent past for reasons which I've already spoken about, but these are getting which are very, very attractive. The drivers also for growth are very much in place for picking up. So the India Opportunities Fund is our multi-thematic fund, as we call it. It's a fund which allows us to look across the overall economy and the market landscape, and then identify the key themes of the moment which are likely to drive the markets forward. The idea here is that you can have the possibility of generating uncorrelated returns by having a focused approach to specific themes. But the heart of it is still a disciplined bottom-up construction. So when I mean that you have multiple themes with dynamic ways, what that really means is that if you look at the current construction, you have three main themes. One is rising affluence, second is Make in India, and the third is digitalization. Each of these are pretty unique in their own right, where rising affluence speaks to favorable demographics and rising income levels, leading to consumption-oriented theme, but also a premiumization trend in India across various categories. It also touches a bit about financialization, adoption of financial deepening of financialization across household savings, and so it really touches on a lot of the changing nature of consumption in India. On the other side, Make in India is quite different from that, very different from that, and it's about how manufacturing has been picking up across a range of sectors. And as I said, this union budget has only served to pick up on that. The good part about the Make in India kind of theme is that it's not restricted to any one sector. When maybe about a couple of 2-3 years back, we felt that the best representation of Make in India was the defense sector, and we had overweighted the defense sector quite massively. But maybe in 2024 we turned more cautious on the defense theme after their run up very sharply. So we had instead shifted to some of the other parts like more like industrial and electricals, auto auxiliaries, communication services instead. Finally, I think digitalization is just basically how there are a lot more IPOs also which are coming in this space. The shifting of offline to online is creating new opportunities across a range of sectors. So within this, you would have food delivery, you may have financial names, you may have fashion and e-commerce. All these fall under the digitalization theme, which are using all the new digital technologies to drive their growth. I think so, and we're seeing, of course, now one more new one IPO coming along this line, which is going to be a large IPO as well. So there are three themes really, and they're definitely multi sectoral. If you look at the overall portfolio as well, it's a very actively managed portfolio. We have this is also it's also a multi-cap kind of a portfolio in terms of 45% being in large caps, about 30% being in small caps, and a bit more than 30%, and mid caps being about 15-16%, 16-17% as well. So together, it ends up being a very well diversified across the cap ranges as well. If you just look at the performance has generally been exceptionally strong over the last 2 or 3 years. Last 1 year has been a slightly slightly rougher, and should address some of the performance issues, which it's not done as well as we expected to do and we wanted to do. So these are some of the names which have contributed and maybe not detracted from the performance. So Amphenol is an international company, so this has the flexibility to buy some international stocks as well. This Amphenol is playing into some of the global AI trades as a fastener for some of the data centers building out, which is happening. And on the detractor side, you've seen some of the chemicals and pharmaceutical names which have contract manufacturing there has hurt a little bit. So going ahead, we are looking at this changing and improving as the year plays on. Which moves us to the Franklin India Multi-Cap Fund, also managed by the same fund manager. Here we have seen there are real focus on more on the quality compounders, and with the exposure to some cyclical sectors as well, has meant that we have been able to relatively hold on better than many of our peers. The framework determined market cap allocation also means that they are about more tilted towards large cap than the mid and small cap, and that tilt has also relatively helped us. This is something which we expect to help us in terms of timely rotating through the mid and small caps as and when the opportunities come. I think, as I already said, small caps have underperformed, but we expect sometime towards in this year the small caps to start approaching very attractive levels. I think that's something which we're looking forward to, and the multi-cap should be well positioned to accordingly change weights towards mid and small caps as that happens. Look at the portfolio as well. It's now got more risk in the bank space, whether it is an SBI or Axis Bank, HDFC Bank, Kotak Bank. This plays into our lending theme, which we are very positive on. And we have, of course, some exposure to the industrial product side, which is playing on the data center theme, which you're positive on. So in terms of contributors and detractors, banks, a couple of banks helped us. Ashok Leyland is representative of the commercial vehicles space starting to pick up and starting to do well, while HPCL was a beneficiary of some of the declines in declines in terms of the oil prices itself. While again here among the detractors, we see some of the material names, which is chemical side, where we have taken a large position, but we have not yet seen the best of that starting to play out. We think that that is something which can turn with the anti-innovation trade playing out there as well. Finally, on the small cap fund as well, this is a great. I think we're reaching the time where we can start taking a staggered approach to investing in the small cap space, and should benefit from the volatility which the market is offering right now. Here, if you look at the kind of stocks which we are exposed to, we are one of the bets which we have is on the realty space. So that's our top holding, Brigade Enterprises. The decline in the home loan rates, along with the fact that realty, so in the real estate space, what's important to do, and I guess all of small cap really is about going stock by stock and picking those correct names. I think it's more about stock selection than maybe sector allocation, and that's so here we have our topic is something which has the tailwinds in the markets as well. So we expect this to turn around as well. We have a small bank as well, which is not done as well. So it's a bet that this is going to participate in the lending pickup. So this is among small banks which have not yet done well. Again, a couple of pharma names where we are expecting developments in the pharma space to benefit it this year. As is electronic manufacturing, Sirma is a play on the electronic manufacturing space, which, as you've seen, has been helped by the trust which is being given in the union budget as well. One of the names which has not helped us this year is right at the bottom of this on the jeweler space, and this is despite the fundamentals still holding up, the growth continuing to play out. There have been some concerns which we think are unfounded on this stock. And that means that we expect this to start recovering as well. So I'll pause here.